cash purchases. We purchase the goods and pay the cash. What is going out? Cash is going out. Goods is coming to the extent of 2,30,000. Deposited into the Bank of Baroda 25,000. We put the money in the bank to the extent of 25,000. Who is the receiver? Bank. What is going out? Cash. We put the money into bank account. Who is the receiver? Banker. What is going out from you? 25,000. Hello, my dear student. I am Dr. B.S. Subramania, called by name Dr. BSS, Professor in Commerce and Management, Vidhyaashram First Grade College, a Temple of Excellence, MYSURU. In this session, I am going to have Fundamentals of Financial Accounting first semester, Unit 1, Session 4 in favor of BCom of Problems on Journal Entry. I told there are three. Accountancy can be divided in three groups: personal account, real account, and the nominal account. A personal account is one which deals the accounts of person. A real account is one which deals the accounts of property. A nominal account is one which deals the accounts of profit or loss. There are golden rules for this: personal, real, and nominal. What are that rules are? For personal account, debit the receiver, credit the giver. What is that rule? Debit the receiver, credit the giver. For a real account, debit what comes in, credit what goes out. For nominal account, debit all expenses and losses, credit all gains and income. We'll move on to problem now. Generalize the following transaction in the books of Miss Kanchana, 2015, January 1st, commenced a business with the following. He put into the business cash, he put into the business goods, he put into the business furniture, he put into the business building for commencement. Commencement means capital. What is coming in? Cash is the real account, debit what comes in. Goods is the real account, that is comes in. Furniture is also real account, it comes in. Building account also real account. Debit what comes in, credit what goes out. Debit you have to write first, credit you have to write second. How? Debit you have to write first, credit you have to write the second. So we'll move on. We'll pass the entry now. What is the entry? First one, cash at date 1/1/2015. Cash account debtor. What's the value? 88,000. Goods account debtor. Goods account debtor 68,000. Then furniture account debtor. Furniture account debtor 52,000. Then building account debtor 1,20,000 to Kanchana Capital. Add the figure. 1,20,000 plus 52,000 plus 68,000 plus 88,000. 3,28,000. 3,28,000. Being business commenced. What's the entry? Cash account debtor, goods account debtor, furniture account debtor, building account debtor to Kanchana's capital. Who contribute? Kanchana. Debit what comes. How to pass? It's called compound entry. cash account debtor, goods account debtor, furniture account debtor, building account debtor to Kanchana's capital account. Totally he contributed 3,28,000. Second one, next one, 3.1, cash purchases. We purchase the goods and pay the cash. What is going out? Cash is going out. Goods is coming to the extent of 2,30,000. Purchases account debtor, 2,30,000. To cash account, 2,30,000. Being goods purchased. So we purchase the goods and pay the cash. What's the entry? Purchases account debtor to cash account. Then we want to next entry. This is on 5th. Rent paid to landlord rupees 4,000. We are paying the rent. What is going out? Cash is going out because of the rent. Who may be paid? You paid only 4,000 is going out because of the rent. What's the entry? Rent account debtor to cash account. On 5th, rent account debtor to cash account. What's the amount paid? Rent paid 4,000. Being rent paid. Rent paid to landlord. On 7th, this over. Invested in NSC, National Saving Certificate, rupees 10,000. Cash is going out. Invested where? NSC, National Saving Certificate. NSC account debtor to cash account to the extent of 10,000. On 7th, NSC account debtor, National Saving Certificate account debtor, 10,000 to cash account. 10,000. Being amount invested in NSC, National Savings. Cash is going out. You put the purchase the National Saving Certificate. It is on 7th, NSC account debtor, 10,000 to cash account, 10,000. Being NSC purchased. On 9th, deposited into the Bank of Baroda 25,000. We put the money in the bank to the extent of 25,000. Who is the receiver? Bank. What is going out? Cash. So bank is banker, person debit the receiver. What is going out? Cash to the extent of 25,000. Bank account debtor, 25,000 to cash account. $25,000 being cash paid into bank. We put the money into bank account. Who is the receiver? Banker. What is going out from you? 25,000. Debit what comes in, credit what goes out. Bank means personal account. Debit the receiver, credit the giver. So 9th over 11. Sold goods to Anita on credit rupees 45,000. We sold the goods. Who is the receiver? Anita. Anita is a personal account. Debit the receiver. So what is going out? Goods is going out to the extent of 45,000. Who is the receiver? Anita. On which date? 11. How much money? 45,000. That is on 11th, you know. See that? 11th. Anita's account debtor 45,000. To sales account. We sold the goods to Anita 45,000. Being goods sold to Anita. This is 11th credit transaction. Who has to pay back our money? Anita. 11th over. Then return goods from Anita. Out of 45,000, how much goods is returned? 3,500. From whom? Anita. Debit the receiver, credit the giver. What is coming in goods? It is nothing but sales return. Sales return account debtor. What's the value? Return goods 3,500. From whom? Anita. Being goods returned by Anita. So we sold the goods at 45,000. Out of that, how much goods returned? 3,500. 15th over. Purchase furniture and paid by check 18,000. We purchase the furniture. What is coming in? Furniture. How much check is going out? 18,000. Instead of check, we write the map. What is coming in? Furniture. What is going out? Check 18,000. On which date? 19. Furniture account debtor to bank account. What's the value? 18,000. Being furniture purchased. Being furniture purchased by check. When it comes to check, you have to write the bank. So furniture is coming in, check is going out. That is on 19. Then come back to 21st, 19. Then we have got 24th, 21st, no entry. Then on 24th, withdraw goods from business for personal use. Withdraw goods from business for personal. Withdraw how much? 5,200. For personal use means drawing. To the extent of how much? 5,200. On which date? 24. Drawings account debtor. Anything drawn for personal use? What's the value? 5,200. To purchases account. $5,200. Being goods drawn for personal use. Being goods drawn for personal use. We take the goods from purchases for personal use. Then on 28th, 24th is over. On paid to Anita on account rupees 22,500 and discount received 500. We paid to whom? Anita. Who is the receiver? Anita. How much cash is going out? 22,500. How much discount received? 500. On 28th, Anita's account data. He is the receiver. To cash account, to discount account. This is to discount received. How much you paid to Anita? On 22,500 to cash. 22,500. Then to discount 500. Totally how much you paid to Anita? 23,000. We actually have to pay to Anita 23,000. Out of that, how much cash is going out? 22,500. See the one? Paid to, we are paying the Anita. Who is the receiver? Anita. Anita's account. How much cash is going out? 23,500. How much discount received? 500. Who is the receiver? Anita. Anita's account debtor to cash account to discount account. Being amount paid to Anita. Hope the entry. Paid to Anita. How much cash? 22,000. Discount is a nominal account. Debit the losses. Credit the gain. How much gain we got? 500. Actually paid 22,500. 22,500 plus 500 means 23,000. Goes in favor of Anita. Anything paid by check, in the form of check, you have to write the bank account. What is coming in? Furniture account debtor to bank account. If they paid in cash, furniture account debtor to cash account. All based on 3 golden rules principle, which are the 3 R: personal account, real account, nominal account. What the personal account says: debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all gains. This is the fundamental of accountancy, golden rule. This should be remembered. Till if you want to do for MCOM also, MBA also, CA also, or ACS also, you have to remember this golden rule, which are the 3: personal, real and nominal. Personal goes to person, real account goes to property, nominal account into profit or loss. What's the rule? Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all gains and income. Hope you understand this session. So we'll meet in the next session with the help of trial balance. Till then, goodbye. Meet in the next class with a trial balance.